The S&P 500 versus the QQQ. It's an age-old debate. But if you're wondering where to stash your cash, you're not alone. One gives you a broad slice of the largest companies in the US, while the other zooms in on the tech powerhouses that have been shaping the future. Should you go for the tried-and-true S&P 500, or take a leap into the dynamic world of the QQQ? In this video, we'll unpack the main differences between these two ETFs and explore what might make one more appealing based on market trends, risk, and long-term potential. Let's dive in. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Let's start with the S&P 500. This ETF tracks the top 500 publicly traded companies in the U.S., providing broad market exposure across sectors like tech, healthcare, and finance. Investing in the S&P 500 means betting on the overall performance of large-cap U.S. companies, and it has historically offered stability with an average annual return of about 9% over the past decade. Now let's look at the QQQ. This ETF follows the NASDAQ 100, which is made up of only 100 of the largest and most innovative companies, heavily weighted toward tech stocks. With major players like Apple, Microsoft, Amazon, and Google, the QQQ is all about pushing the boundaries of innovation. In recent years, tech stocks have excelled, enabling the QQQ to outperform the S&P 500 with an average annual return of around 15% over the last decade. So, what does this mean for your portfolio? Let's dive into the numbers. Over the past decade, the QQQ has truly outshined the S&P 500 in terms of returns. If you had invested $10,000 in the QQQ back in 2014, your investment would now be worth over $48,000. In comparison, the S&P 500 would have grown to just over $28,000 during the same period. That's quite a gap. While nearly tripling your investment with the S&P 500 is impressive, the QQQ would have multiplied your money by 5 times. But here's the thing. Past performance isn't a guarantee of future returns. The QQQ's reliance on tech makes it more volatile. Sure, the gains can be massive in a bull market, but when the tech sector hits a rough patch, the losses can be just as extreme. We've seen this happen in market corrections where the QQQ has dropped more sharply than the S&P 500. For example, in 2022, as the Federal Reserve began hiking interest rates to combat inflation, high-growth tech stocks saw significant declines. The QQQ took a hit, dropping over 33% in value, while the S&P only dropped 25%. Although it was affected, it was cushioned by its exposure to more stable sectors like healthcare, utilities, and consumer staples. The reality is, the S&P 500 offers more diversification. It's less reliant on any single sector, which can provide a smoother ride during times of market turbulence. So, while the S&P 500 might not offer the same explosive growth as the QQQ, it's a safer bet if you're looking for stability. Let's get into risk. When deciding between the QQQ and the S&P 500, it's crucial to consider your risk tolerance. Are you okay with more volatility in exchange for the potential of higher returns? Or do you prefer a steadier, more predictable investment? If you're a younger investor with a longer time horizon, the QQQ might make more sense. The tech sector is still growing, and many of the companies in the QQQ are at the forefront of innovation. Companies like Nvidia, Tesla, and Google are literally shaping the future of industries like AI, electric vehicles, and cloud computing. If you're willing to ride the waves of volatility, the QQQ could reward you handsomely over time. However, if you're nearing retirement or simply want a more conservative approach, the S&P 500's diversification might be the better choice. The S&P 500 is less likely to experience extreme swings, which can give you peace of mind during turbulent markets. Now, let's address the elephant in the room: current market conditions. Right now, we're in a highly unpredictable economic environment. Inflation, interest rates, geopolitical tensions, and fears of a recession are all at play. In times like these, tech stocks can be hit hard as investors rotate into safer, more defensive sectors. But here's the flip side. When the economy stabilizes and tech begins to thrive again, the QQQ could quickly recover and outperform. So, timing can play a big role in which ETF performs better. If you believe in the long-term potential of technology, the QQQ may be the right call, especially if you're buying during a dip. So how do you decide? Ultimately, it comes down to your investment strategy. If you're a long-term investor with a high-risk tolerance and you believe tech is the future, the QQQ might be the better choice. Yes, you'll experience more volatility, but the upside potential could make it worthwhile. On the other hand, if you're more conservative, or if you're looking for a set-it-and-forget-it investment that will grow steadily over time, the S&P 500 offers broader diversification and less volatility. It's the tried-and-true option for a reason. So should you choose the QQQ over the S&P 500? The decision really comes down to your financial objectives, risk tolerance, and perspective on the market's future. Take a moment to consider what you're aiming for with your investments, and remember that both options have their unique advantages. Ultimately, the right choice could set you on a path toward financial growth. So choose wisely and let your investment journey begin.